The United States just made a decisive move, pressuring JPMorgan and Bank of America to walk away from a Chinese IPO. Not in New York, but in Hong Kong. China's response was unusual. No press statements, no warnings, just silence. Then came a quiet shift. Billions of dollars in U.S. debt were sold off without notice. No headlines, no ceremony, just precise, calculated exits. This wasn't about a single IPO. What's unfolding now is far larger. It isn't a trade spat or a diplomatic pause. It's a controlled unraveling at the core of the global financial system, one transaction at a time. Washington believed it was tightening pressure on Beijing. Instead, it may have set off something irreversible. Because China isn't responding with words, it's responding with capital. And the global economy is shifting, quietly, but with serious consequences. To understand how this began, we need to go back to a single IPO in Hong Kong. That's where this silent financial clash truly started. But before we go further, make sure you're subscribed and have notifications on, because this conflict is reshaping the global economy one move at a time. It started with a relatively unassuming deal, an IPO on the Hong Kong Stock Exchange. The company was CL, a Chinese producer of lithium-ion batteries for electric vehicles and energy storage, closely tied to Beijing's technology development programs. On paper, the deal looked solid, a projected $5 billion listing, strong institutional interest across Asia. Underwriters included JPMorgan Chase and Bank of America. Everything appeared routine. But behind closed doors, Washington was already alarmed. On March 27, 2025, the U.S. National Security Council issued a quiet but urgent warning. In its assessment, CL posed a strategic risk. Its battery technology could be used in China's naval platforms, including submarines, and the company was linked to state-backed research labs. The listing wasn't in the U.S. It was in Hong Kong. But honestly, that distinction no longer mattered. Within 48 hours, both American banks abruptly withdrew. The impact was immediate. CL's valuation fell by more than $200 million almost overnight. But the damage went beyond just one company. The message was global. The United States had shown it was willing to apply financial pressure outside its own borders, using its firms to enforce policy on foreign markets. Analysts at Georgetown Center for Security and Emerging Technology called this extraterritorial capital deterrence, a new strategy that turns access to capital into a geopolitical weapon. U.S. firms were no longer being guided only by profit. They were expected to align with Washington's strategic agenda, follow the flag, or lose access. Supporters framed the move as necessary containment. CL wasn't just another manufacturer. It was part of the energy and defense backbone of the future. Critics, however, warned of the cost. The U.S. was undermining the global reach of its own financial institutions, injecting national security decisions into private markets, and raising questions about the predictability of American finance. If Wall Street can't operate freely abroad, how long does its dominance last? The intervention also revealed something deeper. Hong Kong is no longer viewed as neutral ground. Once a bridge between East and West, it's now widely seen as a financial extension of Beijing. By acting there, Washington effectively admitted the old rules no longer apply. So was this a clever tactical strike, or a sign that the U.S. is struggling to hold control over a shifting system? One thing was clear. The CL IPO wasn't just a listing. It was a line drawn in the sand, and China didn't respond with outrage. It responded with money. Within days, Beijing began acting. No press conferences, no retaliation announcements. Chinese state banks and sovereign funds quietly started selling U.S. treasuries. According to Treasury International Capital data, China cut its holdings by nearly $80 billion in the first quarter of 2025, the sharpest quarterly reduction since 2016. As of February, China's exposure to U.S. assets, including treasuries, agency bonds, corporate debt, and equities stood at roughly $1.67 trillion. That figure is now steadily declining. This wasn't emotional, it was strategic. Barclays' head of macro strategy described it as diversification wrapped in diplomacy. China isn't pulling back out of panic. It's preparing for a world where it no longer depends on the dollar. So, where is the money going? Reports show capital shifting into non-dollar assets: gold, infrastructure projects, regional bonds, and yuan-denominated debt. Gold purchases surged, with the Shanghai Gold Exchange hitting a 5-year volume high. At the same time, Beijing expanded regional trade corridors designed to reduce dollar usage altogether. This isn't just about buying assets, it's about building a parallel financial system, one that operates outside the dollar-centered order. China has also increased purchases of Japanese government bonds. Holdings of Japan's 10-year debt jumped sharply in early 2025. Japan offers liquidity, stability, and a credible non-dollar hedge. China isn't retreating, it's repositioning, quietly stepping away from one system while assembling another. Wall Street is already feeling the effects. A sustained drop in foreign treasury demand pushes U.S. borrowing costs higher. If China keeps trimming its holdings, interest rates may rise not because of inflation, but because America's largest creditor simply stops showing up. That pressure ripples outward. Higher yields mean heavier debt servicing, tighter budgets, and long-term strain on the dollar's dominance. What we're witnessing is a slow, silent decoupling, carried out with spreadsheets, not speeches. China isn't trying to crash the system. It's building an alternative. And other nations are watching closely. Some are already following. As Beijing steps back, Washington is preparing a counterattack, this time through legislation. In April 2025, the U.S. Senate advanced a rare bipartisan bill aimed at cutting financial ties with China's strategic sectors. The bill targets more than 220 Chinese firms across defense, AI, biotech, and telecommunications. According to Bloomberg Intelligence, these companies represent over $800 billion in U.S.-linked capital, from pensions, index funds, private equity, and ADRs. This isn't just policy. It's a fight over who controls the flow of global money, and the outcome may redefine financial power in Asia and beyond. If the bill passes, major American investors would have just 12 months to pull their capital out. That means firms like BlackRock, Goldman Sachs, and other financial heavyweights would be forced to unwind large positions, fast. The implications are enormous. BlackRock alone manages roughly $115 billion in Chinese assets that would fall under scrutiny. But the deeper shock would hit passive investment vehicles, especially ETFs tracking emerging markets. These funds aren't designed to make political judgments. Yet under this bill, geopolitics would override portfolio strategy. Analysts warn this could trigger a chain reaction. Forced sell-offs would distort prices across both U.S. and Asian markets. Liquidity could evaporate, valuations would sink, and Wall Street's role in Asia's $34 trillion financial market could shrink almost overnight. Already, quiet discussions of voluntary delistings are growing. Chinese firms listed on the NYSE and NASDAQ are exploring exit plans, not because they want to leave, but because legal uncertainty is making it too risky to stay. At the core of this is a larger question. Can American capital still compete globally if it's constrained by geopolitical red lines? The U.S. financial system was once praised for openness, flexibility, and neutrality. Now those strengths are being traded for control. And this time, the fallout won't be limited to a single IPO or one quarter's earnings. It could permanently redefine Wall Street's role in the East, because while Washington attempts to pull the plug, Asia is already wiring a new circuit, and the power is shifting quickly. As the United States escalates financial pressure, Beijing is laying the groundwork for something far more ambitious: a financial system that doesn't rely on Wall Street at all. In early 2025, China's Central Financial Commission committed $423 billion to strengthen domestic financial infrastructure. This funding targets everything from bond underwriting and cross-border settlement systems to fintech platforms designed to rival Western clearinghouses. The objective is pretty straightforward: reduce reliance on United States-controlled financial channels and create pathways where Chinese capital can move without dollar bottlenecks. One of the most significant shifts is China's plan to eliminate dependence on Western credit rating agencies. By 2026, regulators aim to phase out Moody's, Fitch, and S&P from domestic bond markets. In their place, Beijing-backed agencies will assess credit risk using China's own standards. This transition is already underway. In the first quarter of 2025 alone, the Shanghai International Board, often called China's answer to NASDAQ, recorded $112 billion in new foreign listings. And these companies aren't just Chinese. They're coming from Southeast Asia and the Middle East. In the past, many of them would have chosen New York. Now, they're choosing Shanghai. What's changing isn't just infrastructure, it's trust. China is offering emerging market firms something the United States increasingly cannot: access to capital without sudden political risk. No surprise sanctions, no abrupt delistings, just clearer terms. And China isn't acting alone. Regional banks and sovereign wealth funds across Asia and the Gulf are backing the shift, moving equity offerings, bond deals, and listings away from New York and toward Asia's growing financial hubs. As Daniel Rosen of the Rhodium Group put it bluntly, Wall Street's retreat isn't slowing Beijing, it's accelerating localization. That said, challenges remain. Capital controls, limited currency convertibility, and regulatory opacity are hurdles China still faces. But the direction is unmistakable. Each new listing outside the United States nudges the global system further from dollar dependence. Because while Washington tries to freeze the board, China is quietly building a new game, and more players are joining every day. As the United States doubles down on financial pressure, much of the world is quietly diversifying, and doing so rapidly. At the center of this shift is the BRICS bloc, now emerging not just as a political alliance, but as a parallel financial framework. In the first quarter of 2025, the BRICS interbank payment system processed $56.4 billion in cross-border transactions, a 320% surge compared to the same period in 2023. These aren't just symbolic numbers. They signal a real move away from SWIFT and the United States dollar. China is driving much of this momentum, supplying over 65% of yuan liquidity in BRICS settlements. Others are following. In April, Saudi Arabia issued a $4 billion bond entirely denominated in yuan. It was oversubscribed 4 times, with buyers from India, Brazil, and Egypt lining up. The message was clear. Dollar dominance is no longer a requirement for raising capital globally. Meanwhile, IMF data shows the dollar's share of global foreign exchange reserves has fallen to 57.4%, its lowest level in 28 years. While the dollar remains dominant, the erosion is no longer marginal, it's structural. For emerging markets, the signal is unmistakable. You no longer need Wall Street's approval to access liquidity or launch sovereign deals. This isn't simple diversification, it's contingency planning. Countries are building lifeboats before the next wave of sanctions hits. Every yuan-denominated bond, every BRICS transaction outside SWIFT raises the same question. Is the dollar still the default, or just one option among many? Wall Street believed it had time, but this contest is no longer about size, it's about speed. While Washington debates, China builds. United States banks step back. BRICS banks step in, one IPO at a time, one treasury sold, one bond issued in yuan. This isn't background noise. It's a financial power shift, engineered quietly and executed through capital. So here's the question. Is the world still following America's financial lead, or is it already halfway out the door? Share your thoughts in the comments. And if this breakdown helped, hit like and subscribe for the next deep dive.